Hey, everybody. Welcome to the Practical Founders Podcast, where every week we hear an amazing story from a serious founder who built a valuable software company and did it without big funding. I'm your host, Greg Head, and this week my guest is Alan Miegel, the co-founder and CEO of BetterComp. I've worked with Alan as a practical founder advisor, and he is growing a fast-growing company in the compensation data management space for big companies who have to do this in their HR departments, market pricing for all job roles across regions and departments and everything. He came out of that industry and created a modern, fast-growing, efficiently funded company. He raised some angel funding and just did a major growth equity round, growing quite fast. He's a Silicon Valley practical founder. And it's an exciting story talking about the growth equity game from the founder's perspective with Alan Miegel. Are you a member of EO, Entrepreneurs Organization, YPO, Vistage, or some other CEO peer group in your neighborhood? These are great. You meet monthly with other CEOs who are dealing with the challenges of growing a real business, and you get to be around other people who understand what you're going through. A challenge of these organizations for SaaS founders is that you're probably the only SaaS founder in the room. That's why I created the Practical Founders CEO peer groups for B2B SaaS founders who are building valuable software companies without VC funding to meet every month to work on the hardest challenges in your businesses and go deep on the topics that are really important in SaaS that can create leverage in your business and are unique to the SaaS industry. I curate and moderate the group. There are 35 founders who are building serious businesses on the way to 10 million, and half a dozen are beyond that now. So they're real founders who add value to each other and help each other as we build and go through this. If you're interested in a CEO peer group for practical SaaS founders only, I curate and I moderate the groups. Just check it out at practicalfounders.com. and check out the CEO peer group page. We'll have a conversation about it and see if it's a great fit for you right now. Hey, Alan, welcome to the Practical Founders Podcast.
Thanks, Greg. Thanks for having me today.
Yeah, I know you were a listener of the podcast, and you and I did some work together. I helped advise you last year and the year before, but now you're on the podcast with some exciting news. So congratulations, Alan.
Yeah, this is exciting. I still listen to the podcast, so I look forward to hearing myself on the podcast whenever this gets published. So.
Yeah, my wife laughs at me because she jumps in my car, the Tesla with the big screen in the middle, and there's my podcast because I'm listening to it. It's entertaining to me, and I pick up new things, but there's me on the screen, right, of my own car.
It's always weird when you hear your own voice, for sure. So.
Yeah, I'm kind of used to it now. I wasn't used to it in the beginning, and I enjoy it. So I'm excited to hear your practical funding story today as a practical founder. You've been growing your business, BetterComp, and you raised some funding recently, and you're keeping it practical as you're swinging bigger up there. So let's just start off with what is BetterComp these days? Who is it for? What does it do? And why is it so magic?
Yeah. So funny, when I first started the company, people would ask me what I did, and I would just say I'm the CEO of a small, highly unprofitable software company. Then I'd really explain what we do. But essentially, in the world of HR, every company wants to know how much to pay their employees. Small companies doing this kind of a little bit more casually, but big companies buy lots of data sets from lots of different providers. And they want a way to be able to take all those data sets and analyze it the way that they want to look at the data and then interpret the results. So essentially, we help people figure out how much to pay their employees.
And what do you call that? Payment or a compensation?
Compensation benchmarking is usually the term. Compensation market pricing. It's got a few different names, but it's the idea of benchmarking what you should be paying your employees versus third-party data sets, wherever you get those.
Well, practical founders out there with their 5 or 20 or 50 employees are probably not doing too much to, work on get the data for setting salaries and all of that. But if you get much bigger than that, you need the data and standards and benchmarking. And if you're a big company, apparently you just don't work with one service. You get a whole bunch of data sets and you have HR data people that work on this. And
you have compensation professionals that figure out how much you should be paying your employees, what kind of compensation plans you should have, like what do your incentive plans look like, who gets stock, who doesn't. So every time you see a job posting that has a range of salary in it, someone went through an analysis of what should we pay for this job in this location. And they usually use a service like ours to figure out what's the right band to show to new hires, but also the right band to talk about with internal employees when they come ask for a raise, et cetera. So there is a method to the madness about how those numbers are derived.
Yes, the bands, the dreaded bands, Alan. Yes, that come into play as companies get bigger. And how big is your company these days? Revenues, customers, employees?
Yeah, so we are over 80 employees at this point. We're up about 30 employees over last year. Revenue growth's over 80%. So we're really firing on all cylinders. It's been a fun growth trajectory. I remember when we got our 10th employee, I thought that was a big deal. We got our 20th customer, I thought that was a big deal. But now we're up over 200 customers, nearly $10 million in revenue. And we're growing, everything across the board, whether it's customers, employees, product, everything's growing.
Okay, well, that's exciting. Does that mean it's a very SaaS business, or is there some transactional data API thing here? How do you sell this? What kind of
Yeah,
business
we
model?
are pure play multi-tenant SaaS. So we have a
Okay.
single application, all hosted in AWS. We do releases almost every day. So it's a really rapid pace of innovation. All that feedback from customers goes into a single version of our product. So some of our competitors have to have two products and decide, if I have this feature, which one do I put it in, or they have to build it twice. We are pure play SaaS with a modern technology stack. So it's been a fun ride over the last 5 or 6 years now.
And you didn't invent this compensation benchmarking. It's been around for a while.
Mm.
What's better about BetterComp than the big players that have been doing this for a long time?
Yeah. So comp benchmarking has been around for a long time. It started in the 70s. Usually in the past, it was insurance companies. They had benefits brokerages and they wanted to
Ah,
keep their customers tied to them. So they
right?
started querying, like, how much do you pay your people? And we'll give you some aggregated data for this. So there are
Ah,
vendors out there like Mercer, Aon, WTW. These are all big insurance providers, but they have brokerage businesses and help with
yeah,
benefits and whatnot.
yep.
So essentially, people want to take these different data sets from different providers like Aon, Mercer, and WTW. And it used to be that you wanted to take your data sets and use them once a year. You did this process once in a while. You had maybe a different salary range in every country that you were in. And maybe in the US, you might have like a high cost area and a low cost area. Now, what's happened because of the era of pay transparency, every job posting has to have a range with it. And so now the process is a lot more complex. Customers are having ranges in every country for every job family for every job. They're all different.
Wow. Yeah.
And so it creates a lot more need for analysis. And also the data sets are becoming more real time. So now there are data sets that come out every quarter. There's ones that come out every month. And what customers want is to be able to consume whatever data set they have from whatever source they have it from, use it however they want. And so, we manage the complexity of all that process, helping customers use data sets that come out once a year, along with data sets that come every quarter, along with data sets that might change every month, and how they
Amen.
reconcile the differences and use those different data sets appropriately.
So you're not in the data business. You're helping big companies use all this data most
That
effectively.
that's correct. Yeah. The irony is that oftentimes when I explain what we do, they're like, "Oh, where do you get your data?" It's like, well, we don't have our own data. We help companies manage whatever data sets that they have. And that was by design, this idea that you can't really be a data provider and have that be your primary business if you're also trying to manage other data sets from other providers.
Right. Uh-huh.
And so we started with this idea that we are more Switzerland, we'll be more agnostic.
There you
We will
go.
have
Right.
data sets that we offer, but they're not meant to be competitive with the existing data sets that people have. So think of, there are different labor data sets that might be interesting for customers to use, but there's not really like one provider that does those things. And so we want to be neutral and help customers work with whatever data sets they have from whatever data sources they have them from.
Okay, that's awesome. And you're in Walnut Creek, California, just across the bay from the Bay, San Francisco in the Bay Area. Do you consider it Silicon Valley, or is it within eyesight of the hot zone?
Yeah, we're close enough where you can call us Silicon Valley. I mean, you can call us San Francisco.
Yeah,
I wouldn't say that we're not quite like a lot of my friends around here. They work in San Francisco. They're not necessarily in the valley itself.
yeah,
But there's a lot of engineers that are over here. A lot of our engineers that we have live in kind of this East Bay area.
yeah. All right.
We just don't have, our house pricing isn't quite as crazy as on the peninsula itself. So
Just slightly crazy,
just slightly crazy. Still
and
crazy in
practical.
comparison everywhere else, but yeah.
Yeah, a practical founder means reasonably crazy. So, we're in the crazy game and all
Yep.
of that. Okay, so you have had some funding along the way. You did some angel funding and some, from with your some golf buddies, who had made money in tech and so forth. Here, can you explain what you've done with funding and your latest funding round?
Yeah. So I guess I'll start from the beginning. One of the things I did before I started BetterComp, it's actually right after I founded it. I asked a friend of mine that's in VC in Chicago, I said, what do you recommend? And again, he's in VC, he's in venture capitalist. His first advice was don't take VC money, which I
Okay, there you
thought was
go. Yeah.
fascinating. Right. I think at the time I also found the podcast. I started listening to it. And so I looked for other alternative methods to fund it. And the reason not to take VC funding is unless you're going to become a unicorn, unless you're going to be huge,
Yes.
you simply just can't take on multiple rounds
Right.
of funding and by the end of it own 2% of your company or something.
Right. So you
And
did the
so
simple math, Alan, and you just figured out this isn't an equation that works for me. This,
yeah,
yeah. Okay.
exactly. As you take more funding, you lose more control of what you're doing, right? You end up owning a very small percentage of something that you've built, and we didn't want to have that path. And so instead, I put some money in to get it going, put some capital in. Then we did what's called convertible debt. So we did a round of funding using convertible debt.
Uh-huh.
This was back when interest rates were under 1%. So I think at the time we did like a 5% note on it. It was pretty attractive. And then we did a 10% note after a period of time, et cetera. But it was still way better than getting, 0.5% in your bank account. So we raised a few $1 million there. We then did another note on top of that.
Okay.
And then once that converted, it converted the original one. So all of our existing investors were able to convert at a reasonable valuation. They got a reasonable return on their money in the interim. And then when they converted, they became shareholders. They did that about a year ago. And then
Oh,
now we've raised, I don't know if you want to talk about the round of funding now, or I can.
yes. Yeah.
Yeah.
Let's go. It's pretty big news here, right?
Yeah.
Because you're growing fast, and we spent last year. We had a bunch of calls talking about this thing, the growth equity game.
Yeah. I want to first say that you were incredibly helpful in that process. It was, I would say the podcast was helpful to hear different perspectives, but also just your take as an advisor was super helpful. At some point we did decide that we did want to raise some funding, and it became clear that yes, we could have taken some additional growth funding from friends and family. Like I'll never forget, there was one night I was playing tennis with three guys, and I was probably wearing the same BetterComp t-shirt. And one of the guys said, if you ever raise funding, let me know. And I said, well, we're raising a small, convertible debt round right now. And then all three guys I was playing with said, they were all in to help out with the funding. I was like, well, this was a good group to play with. So it wasn't always that easy. I actually did find it easier. The first round of funding, we did 50 and 100K checks. And the next round of funding, we did 250K checks. And it was actually easier to do the higher amount than go,
Interesting.
herd all the cats at a smaller amount. So, but it was interesting. We had gone through those different paths. Essentially, one of the other influential conversations I had was with another CEO in our space. I wouldn't consider them practical founders, but
Yeah.
I was talking to him about his experience in fundraising. And he said, one of the things about fundraising that most people don't know is usually they think of it, you go raise a round of funding and you're giving up 20% of your company or 30% of your company, et cetera. He said, you can raise 5% of your round. It's going to be harder to find one investor to write that check, but you could probably find a bunch of investors to write smaller checks. So you can think of the smaller rounds that we had done as basically selling just a little bit of the company
Yeah. A
to
little
let
tiny
us get to
slice.
the next stage of growth.
Yeah. That's really lean, right? And we'll talk about, why you didn't want to just bootstrap it and get some customers, going, because there's a decision to run at a loss and raise money to support that, to accelerate. And so you did some friends and family as convertible notes, a couple of rounds of that. Anything else? Any debt in there or?
We did a little bit of revenue-based financing to kind of
Okay.
bridge some timing. So there's companies like Founder Path that will help
Yeah.
with that.
Okay.
I'd say it's helpful. That's more expensive, but it's
Yeah.
super helpful if you want to raise something quickly and it's kind of a bridge to your next round.
Yes. Right.
But again, kind of the idea of taking just the minimum that you need to get to that next phase and show some growth. So I think,
Sure.
when I first raised the rounds of funding, we had maybe 25, 30 customers, something like that. And then, the investors, as you see growth, they're getting quarterly updates from you and they're seeing progress and they're getting new t-shirts and things like that. But they start to trust you more and they tell people about you. So like I had one friends and family friend of mine, one of the guys from that night of tennis, he sent us like 6 of his college buddies and business acquaintances that all invested, and then they in turn sent us other people as well.
Yeah.
So, but yeah, a little bit of friends and family, a little bit of revenue-based financing, but no large equity rounds until we got to now.
Okay. So this is in those angel round convertible notes turned into equity, right? Small
Correct.
slices,
Yeah.
right?
At this point, BetterComp has all equity investors.
Okay. And this is just announced here. So congratulations here. Tell us about your latest funding round.
Yep. So we raised a $30 million round from 10 Coves Capital. Some of that is also on the debt side. So we raised some money as well from Silicon Valley Bank.
Uh-huh.
That is comprised of about 17 million worth of primary capital, and then some secondary. So we can do things like, breathe a little easier and get a new car and those kind of things. But we're still majority owners in the business. So
Yeah.
BetterComp founders, executives, and employees, we still own nearly 2/3 of the company, about 65%. So it's a really nice position to be in because we control our own destiny. We looked at other rounds of funding that were earlier that would have been helpful at the time, but would have also helped us or hurt us in that we wouldn't have full control of the business. So this is still a minority stake. We still retain full control. Obviously, we've experienced investors that can help us navigate situations and think through different business initiatives, et cetera. But it's still important to us that the founding team and our employees, we still own the majority of the company.
Okay. So you said 17 million of equity and some primary that goes to the business. Is it mostly primary, meaning, there's pretty good funding that will help you grow, or most growth equity at this phase is mostly secondary, right? The founder wants to take a slice of risk, adjustment, off the table, and it's kind of buy-in for the growth equity guys. It's the price of getting to, funding somebody who doesn't need to be funded or whatever. What can you say about the secondary versus primary?
Yeah, so we see a lot of growth ahead for BetterComp. We see a lot of upside in where we're going, and we frankly didn't want to go sell, 20 or
Oh,
30%. And so it's not that we didn't have offers for a larger stake or for, someone taking a larger percentage ownership, but we just didn't want to sell that much. So,
yeah,
oftentimes they ask you, like, can we buy
of
all of your
course.
business and
They
keep
all
you on
ask
for a
you,
few
right?
years?
How much can we buy? Right? Yeah.
Yeah. And reality is like, well, when you say we only want to sell this much of the company, that just turns off some investors, which is fine. They have
Yeah.
a different model.
Yeah.
So we found investors they were, what they do is minority investments. They don't want to run the company for you. They want you to run it with their help.
Mhm.
And it was the right fit for us because we see a lot of growth potential ahead of us and frankly, don't want to exit too early here.
But you got a little slice of the pie, off the table here, a little secondary, and you have a co-founder as well. And, was that something your senior team was able to do, or, just to be able to, I don't know, buy a new house or something like that, or upgrade the
Yeah,
cars?
everybody, I mean, from a financial standpoint, you don't want all your eggs in one basket. So it's good to
Yeah.
have a little bit of diversification, but I would view it as just that. Like no one's retiring, no one's buying, second homes and those kind of things. It's enough to live a little bit more comfortably.
Yeah.
Also pay ourselves more market rates rather than founder rates, those kind of things. But, in general, we're still very heavily invested in the business. We want it to succeed and we want to leave as much on the table as we can. So.
Yeah. Isn't that interesting? And so, and Silicon Valley debt on top of the equity is a way, generally pretty inexpensively, to accelerate with non-dilutive funding, really, with debt. And is that really what we're talking about here? You're saying we could use that much money to accelerate?
Yeah. So you think about it's kind of an oddity that once you raise a round of equity funding, everybody wants to give you more funding. And it's, I kind of equate it to like if you see a Starbucks go in, then everybody goes in around the Starbucks because they
Right.
know they've
Uh-huh.
done their research, et cetera.
Yeah. Uh-huh.
So we were obviously pretty well vetted to raise an equity round. And then that
Yes.
means that every debt provider in the world thinks their debt's very safe and they can get some nice return on the same time.
Yeah.
And so we obviously go through a competitive process, but we did choose Silicon Valley Bank in that process. And, they're happy to follow 10 Coves and be our banker going forward. And that just allows us for more flexibility if we want to make an acquisition, if we see even more growth potential. We don't have to go raise another round of equity. We can dip into some of the debt, obviously
Yeah.
pay it back. That's how debt works. But it does allow us for some additional flexibility in how we maneuver the business going forward.
Well, we'll talk about how you organized this deal, which wasn't very typical. You were very deliberate about it and organized, and it's a growth equity deal and not a VC funding deal, which you could have done, venture capital funding for that size of deal, but you didn't. And, the business changes a little bit going forward as you go there. But, the deal is happening. The deal has happened. So are you already moving faster now
Oh
and
yeah. Yeah. We started
accelerating
to
your hiring?
hire
Mm.
more people. One of the things we had never done is get the whole company together in person. So we're planning some
Okay.
offsites where we can, the nice part is there are very cost effective places to still get everyone together. It's not like we're taking everyone to New York or San Francisco. But no, we started to hire. We have a number of openings on the website. So if you want to, right now it's engineers and product leaders and
Yeah, so that.
SDRs and things like that. We did decide to take growth equity funding specifically rather than venture funding because those are different things. And I had to say I didn't really know much. I thought it was basically venture and then private equity.
Yeah.
Didn't really understand this kind of area in the middle, which
Yeah.
is growth, which I
Yeah.
know a lot of your guests have talked about over the
Yeah.
years. So
Yeah. Awesome. And yeah, you went through that and we had a lot of conversations about that. So it's an exciting time and a new weight. You have investors who are, have put real money in and care a lot and probably fly out to see you and other things like that. So,
yep.
and I'm sure you like the guys at 10 Coves, Coves. And because you talked to a lot of growth equity partners that were hovering around, you kind of went through a process. How many do you think you talked to, Alan,
Oh
in the last
gosh.
18 months?
I probably talked live to over 50 growth equity
Okay.
providers. That number is probably somewhere between 50 and 100, but it's probably closer to 100.
Yeah. Okay. Well,
Um,
I'm interested to pick your brain on what you learned about that as well. All right. Let's talk about how you got this thing started. The better way to do compensation, pricing, and market pricing. You came out of this industry. Uh,
yeah,
mm,
I grew up in this. Sorry, I don't know if you wanted me to
no, go
just
ahead.
jump. Yeah.
Yeah, you came out of
Uh,
this industry.
I came out of this industry with this idea that like, hey, the industry is kind of broken. It's kind of messed up and it's not really prepared for the future. What I didn't know though is exactly what it should look like. And
Yes.
so essentially, I read the Lean Startup, which you haven't read it. Everyone should
Yeah.
read the Lean Startup. And one of the key messages there is you should get as much learning as you possibly can while expending the minimal amount of effort to get that learning. And so one of the things we did early on is we didn't have any products. We had some ideas like we want faster ways to get data into the app. Like, okay, great. But what we really wanted to do was hear from customers what they wanted. So I interviewed about 30 customers that I had interacted with in the past. And it was actually one of the more liberating asks I ever had of someone else because I could go to them and say, I have nothing to give you. I have nothing to sell you. All I want to do is ask you some questions and then learn from what you have. And people were very kind to take an hour of their time and just tell me about their process. It was a little funny because I clearly knew their industry. I'd been in the space for 20 years, but I got to show up and just ask dumb questions like, tell me what you do. And why do you do that? Right. And it became a learning exercise for me to really hear what the customer wanted, not what I had to sell them. Right. So in the past, I'd been in sales and we'd show what we had and we would try to get someone to buy this thing that we have. But I never really, before I started BetterComp, had a chance to just go to a customer and say, tell me about your business process. What works? What doesn't? What have you thought of that you'd like to have that you've never seen in another application? And we got really interesting ideas from folks. We got some bad ideas too. Some people had
Yeah.
crazy things. But one of my favorite conversations was I talked to a CFO friend of mine, and he didn't really know a lot about comp benchmarking aside from like what he'd get from his HR people when he wanted numbers. And I said, well, what do you want as a CFO when you think about market data and like what the market's paying? He goes, I don't care about any of the work that goes into it. I just want to know what is my job and how much should I pay? And I thought that was one of the most interesting perspectives because that is really all a CFO cares about. They don't care how long it takes you. They don't care how much work is involved. They probably care about the data and they want to know it's good data. But other than that,
Mhm.
they don't really care about a lot of the other mechanics of it. And so that kind of became a guiding light for us that we need to build intuitive tooling that helps people get the work done. But the end result is to get the CFO what they want, right? Or
Mhm.
get the chief people officer what they want to make the right decisions.
Okay. So you were like a senior sales guy at Workday, at PayScale, like,
Mhm.
big shot sales guy. So was it a little rewiring for you to come in and not play this sales jujitsu game right from the beginning? And was that different for you?
Yeah, I mean, it was refreshing, frankly. It was, again, I don't have anything to sell you. I'm showing up and I just want to ask you some questions. And so I got really unbiased answers about what people wanted. And then we just build what they said they wanted. So
And who is we at this point, Alan? Like maybe you two had quit your jobs or something like that, and
yeah,
were
so I was a free agent. I had gotten
okay.
laid off from PayScale back in 2019. And then I started this journey with early on, it was just kind of me doing some conversations. Early the following year, 2020, my co-founder Sandra Leon joined the firm.
Okay.
She had run customer success in the past and had that kind of experience. And we started BetterComp with this idea that we wanted to make the industry better. And so Chandra was along for the ride. Shortly thereafter, our third co-founder joined, Derek Watson. He's our CTO.
Okay.
Derek was just a guy who lives a mile from me that I knew socially. He kind of advised in a few different topics, and I asked him to help out. And he's like, I kind of like this. Like, I like the comp function. I like the people. I like you and I like Sandra. Can we do this together? So it worked out.
Okay. Did you know you wanted to head towards entrepreneurship? Let's say 98% of senior salespeople make good money, don't want to get on the product side, don't want to deal with all the mess. They just want to be on the front end closing deals. But you went off on this venture and said, I think I could build something. This is screwed up. Did you know you were going to start something someday, or
No,
you just found the problem and nobody else was going to deal with it?
I had an idea that, it was like probably late 2019 that I really decided like I should try this and just see where it goes.
Okay.
I was always encouraged. My mom had always said, "Hey, you should start a company at some point." I'm like, I don't want to do that. I don't want to start a company. And then just on the personal side, she got sick with ALS, and she really emphasized to me at the end, "I think you should build something. Leave your mark, leave your legacy on things." And so
Oh,
she left me some capital to start the business. It's how I got the funding to get going. I
yeah.
had some of my own, but without her help, I couldn't have done it the way that I'd done it.
Yeah.
So started BetterComp in fall of 2019. My mom had passed about 6 months before that. So it was
Yeah.
it's rewarding to me to be able to do this both, for what we're doing now and also for the legacy.
And that encouragement. Most parents like to see their kids have good jobs and not do anything too terribly crazy, right? Don't bet at all, right? Is
Yeah.
kind of usual most parents, but your mom was encouraging. Was she, in the entrepreneurial way, or how did?
No, funny. My mom was an artist. Like, I mean,
Oh,
she painted stuff and she sold skirts and things like that. She had didn't understand software at all. She didn't, I took, at the very end of it, I still had to explain to her like what the businesses I worked for did because she didn't quite get it. But she always recognized that like I had a good creative eye, like I had good
yeah,
ideas.
yeah,
I was never really much of an artist, never get my head to tell my hand what to do.
yeah.
But I can tell a designer what I want a page to look like,
Oh,
and
okay.
put some ideas together. So,
Oh,
um,
awesome. So you had an idea. The three of you, got together to do this and figured it out. How long before you had a product that you could sell and get going?
so let's see. We started interviewing people in the fall, probably December of 19. We started probably finished that process around February into March. We started building in March and April, and we had a viable V1 as of July.
Really?
Now, I will say that is viable. Like we
Yeah.
called it,
Small V.
well, most people call it MVP. We called it
Yeah.
MSP. In other words, like what could
Sellable.
we sell?
Yeah.
Minimal sellable product, right?
Yeah.
And so in that July, we started going out to folks, some of the same folks that had done the interviews with us. We went back to some of those same folks and we said, "Hey, we've got something. Can you look at it and give us feedback now?" And they were excited because they got to see some of their ideas in action. And I'll never forget the first woman he showed, a good friend of mine named Katie. She's 20 minutes into the call. She's like, "I'll take it." I'm like, "Well, we're not selling it yet."
Good sign. Yeah. Just
Yeah,
good.
it's okay. So, but oftentimes what we would do is, we'd do these kind of feedback calls, and then every 3 or 4 of them, somebody would say, "I want that," right? And you'd feel this
Oh,
market pull would come in.
there we go.
And so it became less about like what we're trying to push what we're selling, and more like people were like, "I want to be part of what you're building."
Yeah.
And even some folks that weren't quite ready for us, or we weren't ready for them, depending on how you want to look at it, it was clearly like, "I want that. Stay in touch with me because I have 2 more years to go on our contract." Those kind of
Yeah.
things, right?
And what was that? What was the first epiphany, we would say?
Yeah. So, one of the phrases, there are different kind of levels of market fit. You can call it product market fit or marketing market fit. I would also say that there's something called messaging market fit, the
Yeah.
words you use to describe what you do.
Yeah.
And I'll never forget, I was on a call with a big financial services firm, and I said something to the effect of, "What you do right now is too hard, takes you too long, and involves too much friction. What you want to be able to do is just get in there and get the process done and never have to touch it again." And then the VP goes, "I want that. That's the thing that I want." And it's like, okay, we should, whatever that is, we should go build that thing because people seem to
Right.
want that, right?
Yeah.
Now,
The in the movie Napoleon Dynamite, I don't know if you remember the scene. Uncle Rico is selling the Tupperware, whatever, and the person across the kitchen table in the trailer says, "I want that."
yeah,
Right? I'm like, that is the thing. I want that. Right. That's great. So, did you get into revenue after that and start to have paying customers and
we got the early adopters. We basically said, we're not going to charge you anything until you're able to use the product. So you can
Okay.
buy it and you get a free trial for a number of months.
Yeah.
So we got 3 or 4 folks that were early adopters. One was a Fortune 500 customer named NVIDIA. And by the way, never sign NVIDIA as like your 3rd or 4th customer because it's a lot.
Yeah.
But we didn't try to monetize initially. We just wanted happy customers that would give us ideas and continue to work with us on product development stuff. So we didn't start monetizing until spring of 21. And then we
All
were
during COVID. Yeah.
all during COVID. Yeah, it is. You have those kind of moments during COVID of like, wow, why did I go do this thing? I don't have any
Sure.
income, and
Yeah.
I'm paying developers every month to build the product, and who knows if this is going to work. But in hindsight, it was perfect timing for us because we got to build. We got a bunch of resources, a bunch of really good engineers that got laid off from places and whatnot.
Mhm.
And so we built during 2020, and then 2021 it started to sell. 2 months into selling, so we're selling in January and February, and then in March, our 2 biggest competitors merged together. So I woke up on a Monday morning, and I think it was a Monday. And anyway, PayScale had bought PayFactors, and I was, wow, okay, new reality to adjust to. So,
Yeah.
and in hindsight, it became again a great timing for us in that we had 2 competitors merging, a lot of distraction, a lot of
A lot of
fallout.
distraction. Yes. Right.
Yeah. A lot of, raising of prices and trying to squeeze every last dollar out of customers, and really not a lot of innovation coming out of that space. And so in hindsight, it was perfect timing both during COVID and during the merger to kind of slide in and, get a bunch of customers, get pretty big pretty fast.
Well, you raised a little funding along the way, friends and family, angel, convertible notes, and all that. Were the founders paying themselves yet? And you had a couple years of, checks just going out and a little bit more checks coming in to pay other people, or
Yeah. So early on, I didn't pay myself anything. Then I paid myself enough to max out my 401k and just did that. So I had no taxable income. I made a promise to my co-founders, that I was going to pay them before I paid myself.
yeah,
And so I always paid my co-founders more than I made. That's still
yeah,
the case now. And you do have to kind of think of it like you are the last one to get paid in this equation. Like you're not doing this to make money now. You're doing this to make money down the line. And you got a lot of other people that you're going to ask to make sacrifices. You're going to ask to take a bath compared to what they're used to making.
yeah.
And you have to put them first, because as soon as they see you putting yourself first, they're not going to think they're the most important thing that you have.
This podcast is sponsored by my friends at Cypress Growth Capital. At some point in your growth, you'll know you could grow faster with some outside funding, but selling a part of your company to VCs would change your whole game. And we know that's the most expensive growth capital on the planet. That's why so many practical SaaS founders I know have partnered with Cypress Growth Capital when they hit that predictable growth inflection point. For 15 years, Cypress has provided non-dilutive growth funding to bootstrap SaaS founders, including 6 successful founders I've interviewed here on this podcast. Cypress provides enough patient capital for you to invest in your growth without giving up any of your precious equity. They leverage their entrepreneurial and operational experience to provide savvy strategic guidance to help you grow efficiently and build your valuable software company faster. Go to cypressgrowthcapital.com/practical to learn more and set up a time with Cliff Centel to see if there's a fit. Now back to our program. So you were not too far away from getting your first customers and revenues. What did it look like to get up to $1 million? Was it, did you first personally sell all your first customers, and, Derek was leading the product team, and Sandra was, trying to figure out how to keep these customers happy? You're the
Yeah.
mess?
So I was doing some selling. I also had some other sales folks that obviously doing their own selling, and I'm helping them sell at the same
Okay.
time. And that was a really good decision at the time to be able to stay close to what customers were asking for,
Mhm.
right? And not just go kind of defer the sales process. I would say we maybe hired a little faster than we should have on the sales side, probably should have kept it to like me and one other rep, but I looked
Yeah.
at it like, well, we have two more folks, we can sell more and get more feedback, and I can kind of jump on their calls to help out and whatnot. But I would do a lot of, let's see, what did I do? I sent out invoices, I hired people, I implemented Salesforce for us, I implemented QuickBooks for us.
Like you did the hands-on keyboard for all that. Yeah.
Oh yeah, all that kind of stuff. And eventually you start to peel things off. So I hired an accountant. I didn't have to chase down invoices anymore. We hired a recruiter to help with some of it. We hired an outside attorney to review contracts. But, initially when you're in the, founder mode kind of thing, you are doing everything. And then at some point you have to decide what you peel off and when you peel it off. And even now, there's still some things that I do that I probably do from a legacy standpoint, but I will soon peel those things off and have more of a traditional CEO role.
Let me just jump to that. What's left that you haven't peeled off yet on the march
Yeah.
to 10 million ARR?
So we had no dedicated product managers until January of this year.
Okay.
We had some folks that helped with product, and they did different pieces of product,
Yeah.
life cycle management, and those kind of things. But we didn't have dedicated PMs. So now we have a few dedicated PMs. We're about to hire a VP of product that will manage the PMs. And then I will still do things like lead product strategy for us, lead product visioning of where we're going. But there's a lot of methodology behind building product the right way that I'm just not well versed in.
Yeah.
I understand when it's done well, and I want it to be done well, but I'd rather have a professional do it than me kind of dabble in that space.
Right. But, the last thing you gave up was, what is this product for our market in this, complicated space that you know really well, right? You're
Yeah.
still the customer expert in the building, or, hanging out like that.
I don't want to call it the visionary, but I mean, I do a lot of the where should we be going in the future, right? And that is
Right.
now, early on, it was you're building the thing that you want the industry to aspire to. Now we have other constituents. We have customers that want features, and we have products, partners that want features, et cetera. So now it's, kind of synthesizing what do you build and when do you build it, right? Now we have more engineers. We used to have 5 guys. So that's not the burger chain, just like 5 guys that built the software. And now we're up to almost 20 engineers. So you can build a lot more, a lot faster. But
Wow.
it does come with different constituents that sometimes want different things. What customers want is not necessarily what partners want. And then you have the constituency that's your internal folks, and the tooling that they need to be successful in working with customers isn't always what sells the product, or isn't always what, helps you go with, work with that partner. They need their own set of tools as well. So you start to have different constituents that give you different ideas about what should go into the thing that you're building.
Yeah. Founders who are getting to 1 million, the complication is survival and selling and seeing what's what and all of that. But they don't really know that on the road to 10 million, things get a lot more complicated, literally. There's more constituencies, as you said, and more hands that need to be served. It's more of a complex problem. Or bigger engineering team isn't always simpler. So
Yeah,
Right.
it's little companies, little problems, big companies, big problems.
yeah, and you aspire to that apparently.
Yeah.
So not everybody's in the I want to take this thing from 10 to 30 or 50 million, right, with some funding, and you're headed that direction here. What was the year that you just started to really move, get from 1 million to 2 million? Was that like, I don't know, 2022?
We got to 1 million in 2022. We doubled that year and got to over 2 million, and then got to 4 million the year after. So we basically doubled. The first year, we were at the end of the year, we were under 1 million, and the next year we got to 2 million. So we basically tripled the first year and went triple, double.
That's kind of VC talk, right?
Yeah.
Fast growth rates. Did you ever have a profitable year, or you were always, staying lean and practical, but, funding just above your expenses to go faster?
Yeah, we always had I wouldn't say a dilemma, but always a thought process: should we slow down in growth and
Yes.
try to get to profitability?
Yeah.
And we looked at it like, well, let's do enough where we can keep the people that we have and take care of our employees, but have enough growth that we can still keep our optionality open if we want to go raise a round of funding. Because as soon as you start to get to, well, I'm going to slow down and get purely focus on profits, you bring in a different type of investor and you limit your optionality. It's kind of hard to then switch back and go down the VC funding path.
That's right.
And so we frankly looked at VC, but part of the problem with VC is it's never raising just the one round. It's raise one round to raise another round to raise another round. And by the end of it, you raise 3 or 4 rounds. And again, the founders own like this much of the company.
Yeah.
And that is a fine path for a lot of orgs, but we did want to have that optionality. And so kind of having the friends and family and raising the 5 or 7% rounds of funding let us get enough funding to be able to keep our rate of growth up, and also keep our optionality open to have different paths available to us in the future.
Yeah. And I'm hearing it. We kept the little bit of funding to keep the growth rates up, but doesn't always work that way. You get the funding, the growth rate doesn't always follow. But you had a very consistent growth,
Yeah.
right? That you can look back, that magical graph that you've shown, I guess, so many times, and the magic numbers, the virtuous flywheel there that's already started. What was really behind that? Was it, obviously it's a big market and you could get a few customers and start to move it, but were you guys great at selling and getting to the customers, or was this just a much better product? What was the thing that
I think
fueled
it's a
this growth?
combination of things. So, I mean, early on, we probably didn't have a better product. We had an interesting product, right?
Okay.
But people kept seeing this kind of pace of innovation, and
Okay.
some of the early big customers, we have 75 Fortune 500 customers. I mean, we have a lot of big, hairy customers, right?
Right.
Early on, you can't possibly take that biggest one and say, we can work with you.
Yeah.
But you can say, well, here's what we do now. Here's where we're going. Let's keep in touch and talk again in 4 months or in 6 months or what have you. Some of them
Yeah.
wanted to talk every month. It's like, that's a little bit too frequent. But over time, they can see that pace and they're looking at their existing tool and going, well, I just got a giant price increase and my customer service manager left and I got no new functionality. Whereas BetterComp hired some of those people and built those features they told me they were going to build. They saw the writing on the wall that we were just getting better faster than the other guys.
Okay. And you were sending quarterly updates to investors who were following you, and presumably inside the company, updating everybody. And then these customers who are kind of tracking your trajectory. And you actually were visibly showing progress quarter over quarter. I mean, are you that kind of organized CEO that you could sort the chunks and get it done and all of that? Or was it just like you were all speed demons and, headed in one direction? What was it that, not every founder can have that kind of consistent progress?
I'd say a little bit. Growth is never linear. And, you always plot it out in your spreadsheet and it looks like the
Yeah.
same growth rate
Yeah.
month over month, et cetera. And the growth is nice, smooth curve. In reality,
Yeah.
it's a little bit lumpy. You have up downs, up quarters, down quarters. I'll never forget, we signed the 3 biggest customers that we ever had, all signed within 2 days of each other. And it was like, well, that was a good 3 days because that was a $1 million 3-day period.
Wow.
But again, growth is not linear. There are times where like you have a quiet month. Like last year, our January was really light, and last year was still our best year ever, even though we closed 1 customer on the last day of January. It's just
Yeah.
how it worked out. So I would say that like over time it evens out because you get more growth, and like 1 big customer doesn't throw off a lumpy
Yeah.
period. But you start to aggregate, a little bit of like the wins that you have, and things start to smooth out a little bit, and you get a little bit better at forecasting. I will say that when I hired my CFO, 2 Derek's. I had one Derek Watson, CTO, Derek Schlicker, CFO. We have nicknames for them because we have 2
Yeah.
Derek's. But
Mhm.
I showed him the model that I was using, and I don't know if you quoted Napoleon Dynamite earlier. I'll quote
Yeah.
Waterboy now. So, in Waterboy, there's a scene where he says, "Please don't serve that water to anyone. Let me do this instead." Derek looked at my model and said, "Please don't use the model. I'll build you a new one." So our model was good enough to help us keep the growth going and hire people at the right times. But CFOs like much better models that have much prettier
Yeah.
outcomes to it and much tighter in the process. So I will say that my kind of unique skill is I'm probably pretty good at a lot of things and maybe
Yeah.
only really great at like 1 or 2 things, but good
Yeah.
enough to kind of do a bunch of things for us over time and
Yeah.
then eventually hire a professional that can go do those things for us.
Yeah. You can do it long enough to hang on before it breaks completely, to
Right.
hire somebody who can do it way better. Yeah, that's by definition the CEO, and you're the one who took responsibility for this problem in the market. The strategy and the cash flow of the company and the funding. Right? That was all on you through this
Yep.
thing. And
Yeah. I will say that one of the things, the heaviness that weighs in the CEO is really like you own everything, right? Everything stops with you. And, I think one of the things that our customers appreciate about us is we're not perfect, but when we mess something up, we take ownership of it and we really feel when we mess something up, right?
yeah,
I think a lot of our customers have dealt with, private equity owned companies and the employee doesn't really, they're just a passenger on the ship. They don't really care if something works. And I'd say that several of our customers have said, like, it's clear that BetterComp cares about getting it right. You don't always get it right. You don't always get, the feature's not built quite the right way. You got to tinker with it a little bit. But in general, you get a bunch of people that care and, want to make things better.
Well, that's interesting. There's two things you said about these big enterprise customers, and I guess your deals are 50, 100,000, 300,000, depending on the size of the company. These are larger deals there. But they cared about the intent of, your caring and the trajectory of your progress, right? It wasn't exactly what you have right now. They gave you, they care about other things like, making bets about where you're going to be in a year.
They do. I mean, don't get me wrong. They still care. Does the product work?
Yeah,
Does
sure.
it
Yeah,
do what
right.
you want it to do?
Yeah.
But I think you also you start to build some rapport with customers that they trust you, that you said you're going to
Yeah.
build this thing and then you build it.
Yeah.
Right. Or if you mess up something, you don't mess up that thing again. You do something differently to, correct upon mistakes of the past. And, one of our customers is a large retailer. But they said on reference calls, as they do these kind of reference calls for new customers, like, they don't get everything right, but they really care. And they really will try to listen, and they'll really try to drive things into the product. And again, they're not perfect, but they're my favorite vendor that I have. Like,
Oh,
great. You have 30 vendors that you work with and we're
yeah.
your favorite. That's great.
Yeah, right. Well, it's one of the advantages of startups is we care harder, right?
That's right.
And all of that. What was the hardest point here? You're about 80 employees. You just did this growth equity funding round, and it's not a straight line. But what was the hardest part of getting, you know, 1, 2, 4, 8, towards 10 million revenue, 80 employees, 200 customers? Congratulations on that, right? That's, you're climbing the mountain. But what was the hardest part coming up through that?
I think it's the internal expectations that you put on yourself, right? About how long
Oh,
this is going to take or how hard it's going to be or how much money you need to do it.
yeah.
But I've had some friends now that come to me and ask me if they should start a company. I'm like, well, you can, but you should know that everything you do will be harder, cost more, and take longer than you think it will.
Okay, good.
And so it's kind of resetting your expectations around certain things. Like when I talked to my wife about it, I didn't tell her we're going to have no income for 2.5 years. And then we were going to make $16,000 a year for a year or two. So, you have to set expectations appropriately. And then I had a good friend of mine that advised whatever your expectations are, double it and double the time period. So if you're talking in
Yeah.
months, make it, 3 weeks becomes 2 quarters.
That's right. And the cascading doublings in there, and if people say, oh, this is definitely going to happen and we're definitely going to sell and it's definitely going to happen. I said, well, I've talked to thousands and thousands of founders, probably 5,000 founders through the last 10 years. I've never met anybody said that we got there faster and easier than we thought. Right. So your doubling makes sense there. So, but you're still hanging in there. A lot of founders who get to 10 million say, somebody shoot me. I need some money in the bank. It's, I don't want to do this anymore. Going from 80 to 150 to 200 employees, that's even more weight and more complexity. I don't want to go any further, right? And the growth equity isn't a good fit for them. They don't want to take the next turn there. But you want to keep going with this thing and run it.
Yeah.
with
Yeah. I
partners.
mean, the industry is interesting enough that I think we have a chance to really be the next largest firm in the space.
Okay. Yeah.
Right. There are some times where, like, it's hard, right? It's never easy. But if you see the growth potential in front of you, you don't really want to sell yourself short. So I think there's lots of opportunity in front of us. There's lots of good people that we haven't hired yet. There's lots of product that we haven't built yet. So we're still in the building mode. We still listen to customers and still drive that into the roadmap. And so it's still super fun. We have a lot of energy. Like, I have to say, when the funding closed, the day, just process-wise, when you close funding and you have existing investors, usually have to go get a lot of signatures in a short amount of time. And so it was a Wednesday night, and they said, okay, everything's ready for signature. We'll probably close like midweek next week. And I'm like, well, what if I just get the signatures faster? They're like, well, we can close faster too, but you're probably not going to. So just plan for next week. And I got like 32 signatures from Wednesday at 6 until Thursday at 1. And the only reason the last 2 took some time is I had 2 guys on a plane and they didn't have any internet. But we tracked down 30 signatures in like 16 hours or something like that.
And did some of your early investors, your friends, cash out and say, I'll take my whatever, 10X or whatever the thing is and go home? Did you have some people do that?
We gave people the option. So again, putting other people first, we did say that if you want to cash out, there are some options available to you. One guy was buying a house and he cashed out like a small amount, like 50K or something like that. And then no one else wanted to exit. They wanted to stay along for the ride. So
Yeah. Well, look at it, your consistency and how you're viewing this, and you know, I, people felt it was a good bet. Like you're betting on it, and they're following you, so they're betting on the trend, just like your customers are. So, very exciting. All right, let's talk about the growth equity process that culminated in the announcement recently with 10 Coves growth equity. How did you go about it? A lot of growth equity shows up like somebody knocks on the door, finally makes their way in, gives a preemptive offer, and then the people scratch their head and say, "That's interesting, and maybe I'll do it," and it starts something. How did you
yeah.
start this process and know that you wanted to go this direction?
So the depends where you want to think about the process starting, but we talked to growth equity as far back as 2022. Some folks found us, and believe it or not, they have sales teams that outbound. So they
Yes,
look
of
at
course.
things like
Yeah, we all know that.
you can buy databases about how many employees they have on LinkedIn
Yeah.
and what's their social presence look like. And so, they're very nice when they reach out and they talk about, we really have admired your business for a while. We should talk. And you realize eventually they're just, they're being nice. But we got term sheets all throughout the process. So we got a term sheet back in, I guess, 2023 was the first term sheet we got, and another one in late 2023 and early 2024. And we got several term sheets along the way.
And those were kind of preemptive. I mean, they talk to you and then throw something at you, or did
Yeah,
you
I
go through
mean,
a process to get there?
I wouldn't call them full preempts. They were kind of like they had a couple conversations. They talked to a few customers in the space, and they throw some numbers in front of you.
Okay.
I'd say the fastest I ever had it was, I had one call, then you sign an NDA, you send over some metrics, and then I got a term sheet like an hour later. I'm like, well, that was a little too fast.
Little chat GPT term sheet. Right. Right.
Yeah, and I'm like,
Yeah.
I don't think you really know us enough to give us a term
No.
sheet yet. It's kind of like somebody proposing on the first date. Like
Yeah. Right.
maybe, but I want to get to know you more
Yeah.
first. So,
Yeah. So you
uh,
had indications that there was, some funding interest, right? And did you have a sense this was the right kind of funding for you someday, or that we'll need funding, or whatever? You're just trying this on, or did you know that growth equity is the swim lane that you were headed towards?
I figured out probably 6 months into it that, okay, at some point we'll raise a chunk of change and go faster and have an equity partner along with the ride with us. But the right time to take that funding, because early on, like I think the first term sheet we got, it was like $2 or $3 million worth of funding. And like,
Yeah.
well, how long is that going to last us? And can I
Yeah.
just go raise like 1 million or 2 million and just keep going? So again, as you think about like at some point you start to know more about your business too, and you know how much capital you need to raise to get to that, escape velocity. But early on, I'm super glad we never took any of those checks,
Yeah.
because then we would never have taken this check and we'd be a
Yeah.
totally different business at this point. So
Right. Yeah, if you raise too many rounds, like Series A, B, C, D, right, it gets consecutively more difficult.
right.
And so you hung on there, you gritted your teeth, and stayed with Angel. Did you kind of do the math and say, we need to be about this size to get about this valuation, to get about this funding, in a normal size that they want, that would work for everybody, and you kind of had to grow into that?
I think the writing on the wall for us was that we saw the reason we took funding now as opposed to later or earlier for that matter was we saw more opportunity ahead of us in 2025 and 2026. And what we didn't want to do was take not enough funding and not be able to go capture the demand when it happened.
Okay.
Right. So think if there's a bunch of opportunities available. If you're there, I never really lost any sleep over like, are we going to be successful? Like at some point I lose sleep because I was stressed or I had a lot going on. But I really only lost sleep from the idea of like, well, what if we aren't as successful as we can be? Because me being the one making the
Yeah.
decision, didn't equip us to have enough people or resources or whatever to go capitalize on the opportunity. And so now it became, okay, we're big enough where we've got enough revenue and we've got enough
Mhm.
customers and enough, I'd also call it business maturity,
Yeah.
right? If we take capital, we can put it to good use, but not so late that we miss out on the opportunities in front of us and have something pass us by because we weren't ready for it. So it is a bit of a balancing act.
Yeah.
I'd say we probably came pretty close to nailing the timing of it.
Yeah.
That if we'd raised a little bit earlier, maybe it would have been a little bit easier last year. If we'd raised a little bit later, would we still probably been fine? Yeah. So I think it worked out pretty well in terms of timing. We found a great partner in 10 Coves. They're of all the investors that we spoke with, they were my favorite investors. and presented one of the best term sheets, and they're just great people to work with.
And do they know your industry, or are they general SaaS growth equity
They know
investor?
our industry a little bit, but they spend more of their time in the fintech space.
No,
And so they
okay.
have a lot of financial services and fintech type portfolio companies. Obviously, we deal with numbers and we do
Yeah,
calculations and things, but they are not an HR tech or a compensation technology investor. But
right.
definitely a lot of alignment on kind of like how to run the business, how to think about things personality wise. There's different, everyone's got a different personality. You got to imagine that person being on your board for the next 3, 5 years. It's important to find that investor that you really like to work with.
Okay, so that's one of your terms, you would say,
Yes.
there. You talked to a bunch of investors last year, and you got the lay of the land in growth equity. You kind of caught up, right? And you saw the different dimensions and how the big ones are different than the smaller ones, and not everybody's the same. What was the biggest learning about growth equity and all the players you've probably had more conversations with growth equity investors than any founder I know, but what was your learning about growth equity as you went through that process?
I think growth equity is a great tool for the right company at the right time, right? It
Mhm.
is different. Private equities, you're giving up control and someone else is kind of steering the ship.
Yep.
But growth equity is kind of a nice blend of like you're not
Yes.
quite in the VC world and you're not in the private equity world. So
Right.
they're large enough checks that become interesting, but not
Uh-huh.
the expectation is not that you take their funding, you light it on fire, grow as fast as you can, and raise another round, right?
Yeah.
So very much kind of that alignment from a mindset of like, what kind of business do we want to run? I will also say that like the growth equity process is like, initially you just think you run this amazing business and everyone likes you and wants to give you money. And you realize then that they're really nice to you because if they're not, then the other guy that's nice to you is you'll like them more. So
Yeah.
early
So
on,
so all this, inbound we're getting from, growth equity and other investors, you don't really know if they like your business or not. They're just trying to get in a conversation and see, I guess.
yeah, I mean, nobody gets the email from a growth equity investor says, "Hey, we kind of like your business, but we just want to learn a little bit about it so we can invest in someone else." And
Yeah.
there's a lot of investors that do those kind of things. And again, it's a business, right?
Yeah.
But every VC, every growth equity investor, they really want to come across as likable and helpful, and a lot of
Yeah.
them really are.
Yeah.
I think a lot of folks have a lot of great value adds to the business, but your investment is not for everyone, right? So just like I talked to 50 or 100 different growth equity
Yeah.
investors, they probably have 1,000 conversations a year,
Right.
and they probably get into numbers and in financials with a couple hundred, and they might only make 15 or 20 investments in a whole
Right.
year.
Yeah, so there's founder funding fit, right? And on the
Totally.
same side, right? Same kind of thing. And you didn't say, "Well, I got some interest, so I'll close one of them." You said, "There's a lot of them. Let me go sort this and find the few that would be a good fit." What did you think would be a best fit for you for the kind
Yeah.
of growth equity investor?
Yeah, so it's interesting. I mean, we started to categorize people on, do you invest with companies kind of like us? Like if you do a
Yeah.
bunch of healthcare investments, like, well, we're not healthcare. That's completely different. Also check size, right? You get some of these firms that say, hey, I'm calling from XYZ firm. We're a $5 billion fund.
Yes,
I'm
big
like,
checks. Hmm.
yeah, like, okay, well, we don't want to check that big and you're not going to want to write a check that small. So I don't know why we're
Right.
talking, right?
Right.
But you also have like the personalities and you get to know a little bit about like what their board presence is like and what are they like as an advisor.
Hmm.
Some folks offer more help. They have entire teams of folks that
Yeah.
help you in everything from go to market to operations to financials, et cetera. And some folks just say like, listen, we don't have a big team to help, but this is what we do help. We help
Yes.
personally. We make
Yeah.
introductions, but we're
Yeah.
not running the company for you. Right. And I
Yeah.
think there's different flavors of that because there are some times where like you meet somebody you really like the board member, but then you meet the growth team and you're like, I don't know if you know our space really. Right.
Yeah.
And there's other times where it's the reverse, where you really, really like the growth team and they think you can really help you, but they want to own such a large percentage of the company that it doesn't make sense to choose them as your funder. So
And so
uh,
what was important to you, about the right check size, the minority, the good board member, could help you in the space, whether they had experience there? What else was important to you?
yeah, so I also wanted someone who could get in what I call the foxhole with you, could kind of ideate out through some things that you're working through. Someone that you enjoyed interacting with beyond like once you take their funding, I don't know if you know this, you can't give it back. So you better like who you're working with. And it's super helpful to have someone that you just kind of get along with, right?
Yeah.
And you can see going through a hard time with them, and you can see having a hard conversation, or you can see like actually looking forward to meeting with them, right?
Yeah.
And that doesn't mean you have to love them. They don't have to be your best friend. They are not your friend, to be clear. They are
Yeah.
definitely your investor. But at the same time, you want to have someone who's, that you can see yourself in the foxhole with for the next, 5 years.
And you still have control of the business. On the board level, you can decide, and it's a minority investor. They like to have provisions for what happens if you get offers and, selling the company gets them. You know, how do you think about controlling the company with partners?
Yeah. So any kind of minority investor wants some reasonable protections in place. Like they don't want to have you in, they don't want to invest with you today and have you sell for $1 more tomorrow. Like
Yeah.
that's not worth it to them.
Yeah. Yeah.
So they do have some minority investor protections in place, the ones that are standard. I don't want to go into detail on,
Yeah.
on
Yeah.
all
Of
the
course.
things, but we do maintain control of the business. We still own majority of it. We still control the direction. And obviously they have their protections in place around their capital, et cetera.
Yeah.
But it's a nice balancing act where they've got some control, we've got some control, but we still control strategic direction. There's things like they want to be involved with the hiring process, which I'd love their input on. Any kind of big, like we can't go buy 10 companies without talking to them about it. We can't go
Yeah.
do everything that we want, but that's part of what you have. You want someone
Yeah.
to help you with those decisions.
Okay, so what are you going to spend this money on? And this isn't just, a lot of practical founders, they don't know to do if they got $5 million in extra funding, right? Because I could hire another salesperson, another engineer, but you're moving faster than that, and this is pretty substantial sum, to go start spending in debt to accelerate that. But what do you think you're going to spend it on?
Yeah. So it is focusing on the things that we already do well, right? So we already work with customers well. We should sell more BetterComp to more customers. It's also building
So
more
more
things.
salespeople, more marketing, I guess.
More
Or something.
salespeople, more marketing, more
Okay.
presence, right? You want to have all those things get more, right?
Mhm.
You also want to build new product for the future so that your customers can buy more from you or have more. We're investing a lot into AI right now, for instance, a
Mhm.
lot of things we can do around the AI front. But in general, you want to get out what you have to more people. You want to take better care of the people that you have so they buy more from you in the future. And you want to be able to hire more engineers and more product people to go build fun, interesting things. You also get to the point where like now you can do some fun stuff too. They encouraged us to get our whole team together for an offsite, right? That's not directly contributing to growth, but it contributes to culture, right? You get
Okay.
people aligned and you get, we've all been operating virtually for 5 years. It's fun to see, oh, you're a lot taller than I thought. You're a lot shorter than I thought. So
Yeah, started during COVID. Wow, what an experience. Where did you go for that? In person?
we haven't done it yet. So
Okay.
we are planning it now. We're getting everyone together. It was fun to tell all of our employees. So we told all of our employees before we announced the funding so that they had, the inside scoop and felt like it was, very much them first before the market finds out. But we're still planning our our company-wide offsite. We have some folks in Europe too that we're going to go to them rather than them come to us. It just works better logistically.
Yeah.
But we're not going to send everyone to Europe. It's not that kind of trip.
Yeah.
A few of us will go, and then and we're announcing that we're going to go to Lisbon.
No.
And then in the US, we'll find something that's low cost. We couldn't really schedule everything. We get to a busy time and starting in August that runs through November. So we couldn't schedule that and get everyone together in a short amount of time. So we're probably going to do the company wide one more in like the November, December timeline.
Okay. Well, very exciting. Back to the funding game. You kind of narrowed it down. Did you run your own process because you were having conversations with all these people and you could kind of put this together, or did you get an M&A advisor to help run a process for you?
So initially, for the initial set of outreaches, I ran the process on my own. So that was like in 2023, 2024.
Yeah.
Either I ran it or I ran it with our now CFO. It did become clear that if we're going to run something, a bigger process that's more involved, that we probably want some help. And that's mainly because it's distracting. We could have run a process on our own. We probably could have gotten to a good set of term sheets. We probably could have raised a round of funding that way. But if you're talking about the dollars that we're talking about, it is helpful to have an advisor that really runs the process, coordinates with you. Investment bankers make the most beautiful slides you've ever seen.
Yeah. Uh-huh.
But it's helpful to have someone where you can just say, hey, I need a slide that does this to tell the right story. And they go build
Yeah.
the slide. It's also helpful because they will advise you on what does it mean when they say that thing, right? What
Yeah.
does it mean when you get this on your term sheet, et cetera. And again, my biggest fear in this was that I was not going to be good enough to raise it. Like me personally, couldn't do that thing. And
Yeah.
I didn't want to have it be me that left us short of where we wanted to be. So I felt it
Sure.
was a good thing to be able to bring aboard someone that could just help with that process. So
Right.
we used the
You're
folks
kind of
at,
in a sweet spot, the amount of funding and, the number of investors, and you're looking pretty good. Could you look back and say M&A advisors that, we write them a good check, but it was worth it? Can
oh
you?
yeah.
Yeah.
Yeah. We used the folks at Union Square Advisors. They go by
Okay.
USA.
Yeah.
Two main guys we worked with were Chris Appaneel and Phil Kim, and they're
Yep.
both great. The whole process is, they in particular were very good at what they did. I thought they added a lot of value to the process.
Okay.
Would highly recommend them again.
Okay, great. So did you get it down to 3 or 4 or 5 or 10, or, to settle on 10 coves, or, was it pretty clear that there was a front runner?
I mean, it is a whole funnel, right? It's just like a
Yeah.
sales funnel.
Yeah,
So
yeah.
we had, I think we talked to 100 firms that we narrowed it down to 50 that wanted access to our data room. We then got down to like 20 or 15 that were like in the, additional conversations with management.
Yeah.
And then at the end, we ended up with multiple term sheets. So we did get multiple term sheets or multiple bidders. We had, we had some preferred ones, but it was a process. And at the end of it, you really just, you want to be able to not, you want to end up with somebody, but you also want to end up with like your choice of a couple folks that you can make. And so we
Yeah.
had that opportunity.
Oh, great.
It was tough because there are other investors that we did like, and I think I really had nothing bad to say about them. I just liked the 10 Coves folks the most. So
Okay. Yeah, great. Very well said there. And was it a normal crazy process of due diligence and, digging around and all that, or were you kind of on your way to being prepared for
we
having
had
investors
our
dig around?
we had a data room that was pretty tight. Like, and I think that's one of the benefits of a banker, that rather
Yeah.
than you having to scramble when you get into due diligence, like we had our data room ready to go.
Yeah.
And there's always like, here's the data room, here are the questions, here's their additional asks that they have. But we had things pretty tight.
Mhm.
Requests were able to either be turned around by them without us, not without needing us, because they had an answer bank of
Yeah.
things. And they really, like, I was able to take a vacation during diligence. I went to London with my
Oh,
family. Now,
wow.
I was working while I was in London. We were able to get through the process in a way that was, frankly, like, it was work, but it wasn't so bad that it was just painful. I will say that my CFO very much took a vacation when it was done,
Yeah.
because he didn't have to be doing diligence anymore, and he very much deserved that vacation. But
Yeah.
yeah, having someone help you with it can certainly be a benefit.
Yeah, and taking on funding and having the growth trajectory and headed towards growth equity, I think you probably got a CFO earlier than a serious CFO earlier than most practical founders headed towards 10. There's a lot of, $10 million bootstrap SaaS businesses without a CFO right out
Yep.
there. So,
Yeah,
so good.
I think on one of your podcasts, I don't remember who the guest was, but somebody said you probably don't need one at 5 million, but you definitely need one at 10. And we crossed 5 and I was like, "Oh, we're going fast here." Like, I don't want to not have somebody. And so initially we hired them to hire Derek to be a fractional CFO, and then we quickly got pulled, like, well, we're getting towards those numbers a lot faster than we thought. We just better bring him aboard full time.
Okay.
So the fractional piece is helpful because you can kind of get some of the benefit, and they tell you if you're really messing anything up, but you don't have to, you get some work-life balance for them at the same time that they can do a few different jobs and not put all their eggs in one basket just yet.
Okay. Well, you're just closed this deal and you're going to have your first board meeting. Usually it's called the oh shit board meeting by the investors, like all the stuff they didn't know before diligence. Yeah, we got this other thing. We never really talked about it or whatever, but that's very exciting. When you take on investors, they're buying a piece of your company, sending a big check because they want to turn that around. That's their business model. So someday you'll sell the company to pay them back. And, do you see this, headed towards 30 million or 50 million and taking on, some private equity investment or selling to a strategic, or
Eh,
what do you
ki
think here?
it's kind of the same thing as the optionality idea, like, we're keeping our options open.
Yep.
Obviously, at some point, 10 Coves may decide to sell, but we may not decide to sell them. We may decide to
Okay.
keep going and doing what we're doing, right?
Okay.
So it's been a fun ride so far. I had to say, like, the morning we woke up with funding, I thought I was gonna feel this sense of relief, and it was a
Oh,
Friday, so I thought
wow.
I might it was a Friday, my birthday was Sunday. I was like, "I'm gonna go relax for the weekend." And I had so much energy. I woke up at, like, 5 AM, and I couldn't wait to go
Let's
back to
go.
work. Yeah.
Yeah.
So, we're definitely energized. We definitely have a lot of momentum behind us, and it's really fun. We're not really thinking about when we're going to sell or what we're going to do. We'll just keep all of our options open.
That's great. Well, this confident trajectory, I think people can hear it. You're clear about this and your mission and the team and your customers and what you're doing in the market. It's a very huge market. You could build a very big company around this, right?
Yeah, that's the idea.
How big are the biggest companies in this space? Like hundreds of millions or billion-dollar companies?
Yeah, I mean, there's several
Robert?
data providers in the space that are, several $100 million each. Like some of them are a half a billion or so. And that's all in revenue, not in market
Yeah.
cap. The software side of it, there are companies that are 200 million, 100 million. So
Okay.
there are big companies out there. There's a lot of runway in front of us.
Okay. Very exciting. I could see why investors were interested, right? At this confident trajectory and the clear focus that you're
The
putting
part that
on.
I like about our space is it's big enough to be interesting, but not so big that there's a bunch of VC coming into our space. It's small enough that, VC
Oh,
doesn't generally
right.
want to invest in our space.
Right. Yeah. It's hard to create decacorns in that space.
That's right.
Very interesting. Okay. And you've got an AI opportunity as well. Okay. So, Alan, you talk to, founder friends out there. And yes, you've been in this quest now for 6 years. And it seems to be working, right? They get your emails and you're always making progress. You always have something good to say. You're clapping about the funding now, and it's still very practical. What is the most common advice you have for SaaS founders out there? Some of the folks that be listening on the podcast that would be most useful.
Uh, I think the most interesting piece is to have that initial foresight to understand, like, what do you want to build? Because there are some people that I've talked to, and they definitely want to go for the shoot the moon. They want to try to build $1 billion company, a unicorn.
Yeah.
Other people I've talked to say, listen, I have a friend he has a small software company. He says, I can come from a lot of money. I want to build this up and make it sustainable, and I want to run it for a long period of time, but never really get that big. It's like, great.
Mhm.
And so I think it's very much like, just know what you want to build, right? And if you don't know, then maintain your optionality, because as soon as you go down one path, you kind of preclude other paths that you might have gone down in the past, right?
Right.
So there
And when
are,
you say what you build, like what kind of company and what kind of end game kind of thing, right? Which, it's hard to predict there, but as opposed to what kind of product.
yeah, I think the product, you have to find something that people want. You have to find that market fit.
Yeah.
And I will tell people, first thing, go read The Lean Startup. It's a great book for understanding, like, how to build a company in the first place. But then I now give the advice of, like, do the least amount of investment that you can make to see if you can get to the next stage, right?
Hmm.
Like, can you build something on the side that you get some feedback on, right? Is not in your space. Maybe it's a different industry, so you're not, getting outside of your non-competes and things like that. But at the same time, like, don't go hire 10 people and don't go take a bunch of funding. Like, can you do a little bit with your own before you risk someone else's money, right? And just get that lesson learned before you go to the next step. And it's okay to do the kind of incremental as you go and keep going, right? You can go down the venture path too. You can go raise a bunch of funding.
Hmm.
There are other companies that have raised, 15, 20. Back in 2021, there were companies raising $20 million with no revenue, basically. At the time, I was super jealous because they had a
Yeah.
lot of money to go play with. And then now I think, I don't know if those founders would make the same choice again, because it leads you
Yeah.
down a different path.
That's right. Yeah, they got trapped there. Well, it's very exciting, Alan. I spent a lot of time with you last year with the calls, kind of scoping this out and giving you extra perspective. And here you are on the other side of it, and you know you're admitting that it's hard, but you're making progress. It looks like a flywheel that's accelerating, and you're excited about that. That's very exciting for a founder.
It's very exciting. And again, the calls with you, Greg, were super helpful. The podcast itself was helpful, but also just having you as a sounding board
Yeah.
that, I remember there was one call we did early on. And one of the toughest parts when you don't have funding, you don't have investors, is no one really tells you you're doing well. Right. And you think, like, oh, like, we're, we only, I thought we'd signed 35 customers. We only signed 32. Like,
Yeah.
I missed my
Yeah.
expectations. And then I remember I gave you some metrics and you're like, wow, you're doing really well. I'm like, oh, good. I didn't know that. So,
Yeah.
because a lot of what you can compare yourself to are venture funded companies, which have a totally different growth trajectory. And, like, What do you mean you didn't 10x this year, right? And I think you kind of put down a reality of like, well, listen, for what you're doing and what your profile is, you're doing pretty darn well. And it honestly, I remember the first conversation I had, I just slept better that night, right?
Yeah.
So thank you for helping me sleep, I guess.
And now you have a new quest, a new mission, for the next few years. Well, Alan, thanks for sharing your story, and congratulations on a good fit growth equity round that can help you achieve your vision.
Thank you. We really appreciate the time today, Greg. It's been great.
Thanks for being on the podcast.
Thank you.
Thanks for watching this week's interview on the Practical Founders podcast. Be sure to like this episode and subscribe to the Practical Founders YouTube channel to keep up with my weekly in-depth interviews with serious software founders who are building valuable software companies without big funding. You can check out my blog, all the podcast episodes, and information about my Practical Founders CEO peer groups at practicalfounders.com, or message me on LinkedIn if you'd like to connect. See you next week.